At its peak, WeWork was valued around $47 billion. That number made it sound like a generational technology company, the kind of platform investors imagine can scale almost without friction. But the thing underneath the pitch was much more physical. WeWork took office space under longer commitments, made it feel modern, and sold flexible access to people and companies that wanted desks without traditional leases. That is the whole contradiction. The company sold a software style dream while carrying an office company risk. Every new location could look like growth, but it also meant more space to fill, more build out to justify, and more obligations taken on before demand had fully proved itself. That gap matters because valuation is a promise about future margins, not just popularity. If the margin story depends on offices behaving like software, the whole thesis turns on whether physical commitments can disappear inside branding. WeWork's story asked investors to believe they could. So this is not just a story about hype, it is a story about a business model wearing the costume of a tech platform. The question is how so many smart people looked at leases, desks, and occupancy and still saw a $47 billion future. The useful version of WeWork was simple. Traditional office leasing is slow, expensive, and rigid. A young company might not know how much room it needs next year. A freelancer may want a professional place to work without signing a long agreement. A remote team might need a city presence without building an entire office operation. WeWork stepped into that gap with design co-working spaces, flexible memberships, and the language of community. That product solved a real problem. The mistake is not that shared office space was fake, it is that the product was treated like something with software economics. An app can add a new user without renting another floor of a building. WeWork could not. The company had to secure locations, improve them, operate them, and keep them occupied. So before the drama, the founder story, or the failed public offering, the core issue was already visible. WeWork had a modern product sitting on top of an old and heavy real estate base. What made the story powerful was that it did not stop at desks. WeWork was pitched as a brand for how people would work, gather, and live inside cities. The company eventually tried to frame itself as the We Company, a broader life and work platform rather than just a co-working landlord. That framing mattered because investors were not only buying current offices, they were buying the idea that WeWork could become a global layer over work itself. In that version, every building was not just a building, it was a node in a network. Every member was not just a tenant, they were part of a community that might create data, loyalty, and pricing power. If the market had valued that as a real estate operator with a useful brand, the story would have been less spectacular but easier to defend. The premium came from treating the brand as if it could break free from the buildings. But here is where the pitch starts fighting the business model. A network can look light in a slide deck. A lease is not light. Each new city required commitments before the company could know whether demand would remain strong. The bigger the dream became, the more the company had to behave like the very thing it was trying to transcend. The mechanism is easy to miss because the offices looked finished by the time customers arrived, but the risk came earlier. First, WeWork had to secure space, then it had to turn that space into a place people wanted to join. Only after that could flexible memberships start paying back the commitment. In a strong market, that can look brilliant. Fill the building, charge members, repeat the model, and the brand appears to get stronger with every location. But if demand slows, the order of operations becomes brutal. The obligation is already there. The build-out already happened. The members, however, are flexible by design. That mismatch is the heart of the collapse story. WeWork promised flexibility to customers by accepting rigidity for itself. The customer could treat the office as optional. WeWork could not treat its own footprint that way. This also explains why the same growth number could mean two different things. To believers, another location showed demand and ambition. To skeptics, another location also meant another bet placed before the payback was certain. So when people praised the company for growth, they were often looking at the visible side: more locations, more members, more brand awareness. The less glamorous side was fixed exposure. Growth did not just create scale, it created a larger machine that had to keep being fed. Capital made that machine look smoother than it was. When funding is abundant, a company can expand fast enough that the newest growth story distracts from the older locations that still have to mature. Private investors can focus on trajectory: more cities, more recognition, more proof that the concept travels. That is how a physical business can start being discussed like a winner-take-most platform. The $47 billion valuation was not just a number. It was a vote that the story was more important than the current economics. But capital does not remove the underlying trade. It only buys time. It can pay for expansion, absorb losses for a while, and keep the company moving long enough for believers to imagine the operating model will eventually catch up. In a stricter funding environment, the company would have had to prove each location with more patience. In the fantasy environment, speed itself became evidence. The problem is that time runs in both directions. If the economics improve, the story looks visionary. If they do not, every new commitment becomes evidence that the company scaled the problem. SoftBank later became part of the rescue and restructuring story, which makes the irony sharper. The money that helped support the dream also had to help stabilize the aftermath. The public offering process changed the audience. In private markets, the story could be carried by momentum and belief. In public markets, the company had to be explained to investors who were trained to compare claims against filings. The S1 process forced people to study losses, lease exposure, and adjusted metrics instead of only the growth narrative. That did not create WeWork's problems. It made them easier to audit in public. The document meant to sell the company became the document that taught the market how to question it. And once that happened, the magic language started to lose power. A phrase like community sounds valuable. A phrase like platform sounds scalable. But losses, obligations, and complex adjustments push the viewer back to basics. How much risk is being taken before the revenue arrives, and does the upside justify it? This was the rehook the company did not want. Once investors looked past the growth curve, they found another problem sitting beside the economics: the person and governance structure controlling the story. Adam Neumann was central to the WeWork myth, so scrutiny of the company naturally became scrutiny of leadership. The legal safe point is not that one personality alone caused the collapse. The sourced point is that public attention focused not only on economics, but also on founder control, conflicts, and governance questions around Neumann. That matters because founder charisma can be an asset in private fundraising. It can help a company recruit, raise money, and convince people that an ordinary market is about to become extraordinary. But the same charisma can become risk when investors want discipline. If a company already asks the market to believe in future economics, governance has to increase trust. It cannot add another layer of doubt. That is why the founder premium turned into founder risk. The more investors questioned the numbers, the more they also questioned who had been allowed to shape the numbers, the language, and the limits around the company. WeWork was not only asking the public market to buy a business, it was asking the public market to buy the judgment system behind that business. The turning point came in 2019 when the IPO path stopped looking like a celebration and started looking like a public rejection. The company postponed the offering, and Adam Neumann stepped down from the CEO role during the crisis. That sequence is important because it shows the difference between private belief and public discipline. Nothing about the buildings changed overnight. Desks did not suddenly become less real. The lease commitments did not suddenly appear from nowhere. What changed was the market's willingness to value the company as if the fantasy could outrun those facts. Once that willingness broke, the story had to be rewritten in survival language. The company no longer looked like a clean hypergrowth debut. It looked like a business that needed rescue, restructuring, and a much harder conversation about what it actually was. This is the moment when the costume came off. A textile story had carried WeWork to a giant private valuation. Public scrutiny forced the question that should have been asked earlier: if the company is really an office operator with flexible memberships, what is it worth when growth slows and discipline arrives? The failed IPO was not the end of the story. That is one reason WeWork is useful as a corporate graveyard case. The company still had offices, customers, employees, and a service people could use. It eventually reached public markets through a SPAC route after the failed 2019 IPO path. But a different doorway into public markets did not erase the underlying issue. The real estate footprint still had to make sense. The lease burden still had to be managed. The company still had to prove that flexible office demand could support the commitments required to supply it. Then came the final proof that branding could not wish away the balance sheet. WeWork filed for Chapter 11 bankruptcy protection in 2023. The bankruptcy was not just a bad ending for one company, it was a warning label for an entire era of story-first valuations. After that, the story centered on a smaller, restructured company and a renegotiated real estate footprint. That is the quiet part of the lesson. The fix was not a better slogan, it was bringing the footprint closer to what the economics could support. The lesson is not that co-working vanished or that flexible offices have no use. The lesson is that a useful product can still be overvalued if investors confuse the customer experience with the company's economics. WeWork sold flexibility, but it had to survive the fixed side of that promise. The reusable test is simple. First, what obligations does the company take on before it earns revenue? Second, how flexible are the customers compared with the company's own commitments? Third, if growth slows, who absorbs the downside? Apply those questions to WeWork and the tech fantasy becomes easier to challenge. The company could talk like a platform, but it still had to lease space first and fill it later. It could sell flexibility, but that meant customers had more optionality than the company did. And when public scrutiny arrived, governance questions made the whole thing harder to trust. This test is useful because it separates product love from business quality. Customers can love the experience while the company still carries a fragile structure. Investors can admire the ambition while still refusing the multiple. This is why the story matters beyond WeWork. A big vision is not automatically bad. Sometimes vision is how a company creates a new category. But the larger the vision, the stronger the controls need to be. If the pitch asks investors to ignore near-term economics, then the evidence and governance have to be cleaner, not messier. What survived after the fantasy died was smaller and more grounded. The post-bankruptcy story centers on a restructured company and a renegotiated real estate footprint. That ending tells us the real lesson. Flexible office space can exist. A co-working brand can serve real customers. The impossible part was asking the market to value a lease-heavy business like the physical constraints would somehow disappear. WeWork did not collapse because every part of the idea was useless. It collapsed because the story outran the obligations. When a company sells a software dream on top of fixed commitments, the fixed commitments eventually ask for proof. And in WeWork's case, once investors stopped buying the fantasy, the office company underneath had to face office company math.